Hello, my name is Rory DePaula. I chose to analyze Broadcom Corporation and Texas Instruments Incorporated for my report. First, I'm going to start talking about who we are and who are our shareholders. Broadcom Corporation provides semiconductor solutions for wired and wireless communications. Its products offer voice, video, and data, and multimedia connectivity in the home, office, and mobile environments. The company operates in two segments: broadband and connectivity, and infrastructure and networking, with 86% of shares held by institutional or mutual fund owners. Texas Instruments Incorporated designs, manufactures, and sells semiconductors to electronic designers and manufacturers worldwide. The company operates in three segments: analog, embedded processing, and other, with 88% of shares held by institutional and mutual fund owners. The top 10 major shareholders for each company own almost the same percentage of shares, whereas Broadcom investors own 43.87% and Texas Instruments investors own 43.72%. Why do investors care about our cost of capital? Investing in a business carries significant risk, so because of that, shareholders expect to be rewarded with a higher rate of return. The cost of funds used for financing a business. The cost of capital depends on the mode of financing used. It refers to the cost of equity if the business is financed solely through equity, or the cost of debt if it is financed solely through debt. Many companies use a combination of debt and equity to finance their businesses, and for such companies, their overall cost of capital is derived from a weighted average of all capital sources, widely known as the weighted average cost of capital, WACC. Since the cost of capital represents a hurdle rate that a company must overcome before it can generate value, it is extensively used in the capital budgeting process to determine whether the company should proceed with a project. Businesses need profits to provide cash distributions for investors, cash for growth, and cash for a rainy day. Broadcom's current debt-to-equity ratio is 18%, with a WACC of 7.4. And Texas Instruments' current debt-to-equity ratio is 44.68%, with a WACC of 10.09%. High debt-to-equity ratio typically indicates that a firm has been borrowing aggressive to finance its growth, and as a result may experience a burden of additional interest expense. This may reduce earnings. On the other hand, small debt-to-equity ratio may indicate that a company is not taking enough advantage from financial leverage. Debt-to-equity ratio measures how the company is leveraging borrowing against the capital invested by the owners. What is their cost of debt financing? The cost of debt is the effective rate that a company pays on its current debt, which can be measured before or after tax returns. But the after-tax cost is what we see most often. A company will use various bonds, loans, and other forms of debt, so this measure is useful for giving an idea as to the overall rate being paid by the company to use debt financing. The measure can also give investors an idea as to the riskiness of the company compared to others, because riskier companies generally have a higher cost of debt. Broadcom's after-tax rate is 3.48%, while Texas Instruments' after-tax rate is 24.34%. So according to the findings, Texas Instruments has a much higher risk than Broadcom. What kind of cost of equity financing? What is their cost of equity financing? Equity financing is the process of raising capital through the sale of company shares. The company issues shares of its stock and receives money in return to raise funds for business purposes. Equity financing is distinct from debt financing, which refers to the funds borrowed by a business. 7.81%, while Texas Instruments' cost of equity is 10.81%. What is our overall cost of capital? As discussed previously as question 2, the cost of capital is derived from the weighted average of all capital sources, known as the WACC, while Broadcom had 7.4% and Texas Instruments had a 10.09%. Could we lower the cost of capital by changing our capital structure? The trade-off theory of capital structure refers to the idea that a company chooses how much debt financing and how much equity finance to use by balancing the cost and benefits. It is often set up as a competitor theory to the pecking order theory of capital structure. An important purpose of the theory is to explain the fact that corporations are usually financed partly with debt and partly with equity. It states that there is an advantage to financing with debt, the cost of financial distress, including bankruptcy. The marginal benefit of further increases in debt declines as debt increases, while the marginal cost increases. Of course, using equity is initially more expensive than debt because it is ineligible for the same tax savings, but becomes more favorable in comparison to higher levels of debt because it does not carry the same financial risk. Therefore, a firm that is optimizing its overall value will focus on this trade-off when choosing how much debt and equity to use for financing. Companies strive to attain the optimal financing mix, based on the cost of capital of various funding sources. Debt financing has the advantage of being more tax efficient than equity financing, since interest expense are tax deductible and dividends on common shares have to be paid with after-tax dollars. In theory, debt financing generally offers the lowest cost of capital. However, it is rarely the optimal structure since a company's risk generally increases as debt increases. Would more debt create unnecessary risk? Most companies use debt to finance operations. By doing so, a company increases its leverage because it can invest in the business operations without increasing its equity. Leverage helps both the investor and the firm to invest or operate. However, it comes with greater risk. And if an investor uses leverage to make an investment, and the investment moves against the investor, his or her loss is much greater than it would have been if the investment had not been leveraged. Leverage magnifies both gains and losses. In the business world, a company can use leverage to try and generate shareholder wealth, but if it fails to do so, the interest expense and credit risk or default destroys shareholder value. Broadcom could do with some debt since it is under the optimal value of debt by about 6%, while Texas Instruments is way above the optimal debt ratio, with the current ratio being at 47.62% and the optimal ratio being at 10%, which can result in dangerously higher leverage, resulting in higher interest rates sought by lenders to offset the higher default risk. How would a financial restructuring affect the value of our company? A significant modification made to the debt, operations, or structure of a company. This type of corporation action is usually made when there are significant problems in a company, which are causing some form of financial harm and putting the overall business in jeopardy. The hope is that through restructuring, a company can eliminate financial harm and improve the business. When a company is having trouble making payments on its debt, it will often consolidate and adjust the terms of the debt in a debt restructuring. After a debt restructuring, the payments on the debt are more manageable for the company and the likelihood of payment to bondholders increases. A company restructures its operations or structure by cutting costs, such as payroll, or reducing the size through the sale of assets. This is often seen as necessary when the current situation of the company is one that may lead to its collapse. Looking at the financial analysis for both companies and the debt-equity ratio, Broadcom looks like it's doing pretty good with its current financial results, very close to optimal. But on the other hand, Texas Instruments is not close at all to the optimal financial results. What do other companies do? Broadcom is a fairly new company, so it doesn't have much exposure compared to its competitors, but that doesn't mean it's not doing well. Broadcom has one of the lowest betas in Texas Instruments is more neutral, indicating a risk that is aligned with the market. Qualcomm is a significant wireless competitor that is making inroads with connectivity chips, a segment in which Broadcom has been the market leader for quite some time. They face intense competition from a host of well-capitalized competitors, such as Maxim Integrated Analog, Microchip, and microcontrollers. Despite strong position and diverse exposure, they are still vulnerable to the cyclical of the overall semiconductor industry. Are the company's stock fairly priced? Fundamental analysis essentially tells us that the price of stock should be. This can be considered if it is intrinsic or fair value based on its future earnings and return on investment. However, the actual price of stock is determined by the stock market, and the stock market is driven by human emotion. So what we really want to know is what price the stock will be on the stock market within a future time window. Analyzing past stock prices can provide some insight into the future movements. The Gordon Growth model focuses strictly on the effect of future dividends, ignoring the other factors that affect the market price of stock, such as new products, competition, and investor sentiment. Due to this focus, the model is most effective when used in large, stable companies in mature markets that have a predictable rate of dividend growth. The estimated stock price for Broadcom is at $43.41. And after calculating that stock price, I came to the conclusion that the stock was just a little overpriced, and in order to consider investing in this company, I would have to look at other components that the Gordon Growth model ignores. The estimated stock price for Texas Instruments was at $53.54. And after calculating that stock price, I also came to the conclusion that it was a little bit overpriced. And I would also have to see the other components of the Gordon Growth in order to think about investing in this company. Thank you for your time.